Okay, I'm going to start in English like Patrick usually does. Today, HiCash Podcast with me, James Hickson from Match.com, which is a very exciting startup. But for the past 15 years, James worked in Morgan Stanley in London and across the globe. So today we're going to talk about those two words, how they intersect. What can one word learn from the other? Hello, James. Thank you for being here.
Thanks for having me.
So could you expand maybe a bit on what is Match.com? What is the group that you are CEO of?
Yeah, so look, firstly, thanks for the opportunity of being here. We've heard lots about your company and just excited to be sharing on your platform. So Match has been around for 10 years. So we're really in that scale-up phase. We have 3 lines of business. We have traditional consumer lending, we have credit cards, and we have what we call pay later solutions. And so this year we should lend around 180 million.
Yeah.
And if we look at the focus of our business, which has really been on the payment side, we're now one of the fastest merchant acquirers in the Nordics. Just looking at our growth rate, say in Finland this year, we've grown at over 1,000%.
Right.
The epicenter of what we do is make it easy for people to pay. And the principal goal is to give them an option of paying later. And so through our partners, Verifone and Nets, in-store and online, customers can make a decision to get 14 days interest-free credit and choose to pay later. And we can onboard someone, a net new customer in-store in under 2 seconds. Within 14 days, they can either take an installment option, and they can choose to pay in a way that makes sense for them, or they can pay in full. But at our core, I think our ethos as a company is to our customers one transaction at a time. And I think despite this enormous growth rate, we're also in a place where our customers love us. And just this month, our kind of net promoter score was around 82%, so above Apple, above Google, above BMW. So it's pretty exciting, but lots of hard work.
So could you, in terms of consumer benefit, be more specific? Like how does it work from the consumer side? So you go into the store, you walk into the store, and what happens there? You want to buy something, so reward comes at this very moment, but the pain of payment comes later. Or
right.
Well, what's the value proposition here?
Yeah, so I think there's 2, right? So I think you got to think about the reward for merchant as a user of our service, and invariably a promoter, and then for the consumer. And so on the merchant side, we felt that payment was painful. If you're a bricks and mortar store, you are going to have to pay a monthly fee, and you're going to have to cover the credit risk. Your payments might be on a weekly or bi-weekly basis. That's difficult to manage short-term cash flow. And then you're going to have to pay a percentage of your sales. So when we started out thinking about this product as a way of acquiring net new customers, that's why we use payments. We had decided for merchants we wouldn't charge them. We'd process payment instantly, and we'd cover their credit risk. And as a result of that, the value benefit for the merchant is they can just focus on selling.
Right.
And we find that as it's the merchants that are actually pushing the use of our service in our stores in Finland and Sweden. On the consumer side, look, it's about choice. None of us are going to go and buy a kitchen on a credit card.
Obviously.
Or a car.
Yeah.
Or maybe we have an emergency and we need to spend €3,000 to fix that because our dog is sick.
Yeah.
And so in those places, we're giving people the choice of deferring how they want to pay for later. And we'll cover the credit risk there for 14 days. And then they get the invoice in the comfort of their own home, and they can make a choice as to whether they pay it off in full. Maybe they have a part payment, or they choose one of 5 or 6 different installment plans that might be right for them. And what we're passionate about is being transparent on pricing.
Yeah.
And what people don't realize is actually credit cards are damn expensive.
They are, yeah.
If you look at paying, let's say that kitchen, right, over the course of a year, you'll be paying 26 to 30% APR. The American Express credit card is at 76.6%. If you have the British Airways co-branded version, we're at 19.9. So we think it's a mix of those two things we're bringing to the market in a package that is easy to use.
Right.
Because we're deploying our solution to terminals that are already in store, there's no new hardware decision for a merchant to make. It's a decision of, would you like this solution on your point of sale device? It's free. It goes onto the terminal, and then consumers don't then have to interact with the merchant when they make that payment choice at point of sale. They just put in the MASH number.
Yeah.
They just push the MASH button, put in their personal identification number, and we can process the payment instantly.
Right. So on the consumer side, the only thing you have to do in advance is register with Match.com?
Actually, no. We can register in real time at point of sale.
Okay.
So let's take in the Finnish market, we use payment by identity.
Yeah.
So it'll identify you off the back of your social security number. You'll insert your social security number on the terminal. It's cross-checked with the merchant. They do part of the KYC checking. And then we can do all of our AML KYC checks behind the scenes and approve you or not for credit. So that makes us a little bit unique because you can make that decision at point of sale and we can track who you are and where you are using publicly available data with some of our partners.
Right. And in terms of what people actually buy, do you have any data on this?
Yeah. So look, we don't want to be in stores where people are buying diapers.
Yeah.
Right. So that's not our core business. So we don't want to be paying people's restaurant taps or people paying pizzas with our service, paying for taxis. That's not good business for us. That's very high risk. So what we focus on is services and high value goods. So I think great businesses for us are vets, doctors, dentists, mechanics. When people are converting to winter tires, that's a great business segment for us. And then we have some high-end stores, right, like the Apple stores in Finland and so on. They're all good business, high-quality business for us. And what we find is when you pick right in terms of where you're located, you get a very high quality of customer. So you tap very much into the kind of the prime and the near prime segments, which is great for us as a lending business.
Right. Okay. And what kind of future, nearby future, do you see for Match.com? Is like expansion into the markets you're already in, or something new, perhaps?
So look, I think right now we're in the middle of closing an equity round. Right, we're raising between 50 and 100 million to fuel our next round of growth. I feel positive that we'll close that. And then I think it's about capitalizing on the existing opportunities in the current markets first. I think a danger for companies at our stage of growth, albeit a 10-year-old company, is to try to capture every opportunity. And that's a mistake unless you're focused. So for us, in the markets that we're already in, we're going to grow our distribution base. We are going to make sure we execute against acquiring merchants with Verifone and Nets. And then we're going to add follow-on services to retain those customers, be that SMB lending for merchants or some kind of PMS solution, PFM solution for customers.
Right. Right. This is quite an interesting topic, and then let's perhaps move on to other things. But what percentage of your customers return to use your service? Because this is an interesting thing, right? Because when it comes to luxury goods or high value goods, usually it's one off in a few years.
Mm-hmm. So how our business is built on a sustainable foundation, and that's our revolving credit product. And so actually, we just think of payment as an acquisition channel to offer people our revolving product, which again is very well priced, risk adjusted. And so what we have found historically is we retain customers for 5 years. And they use us or make an additional withdrawal at least 9 more times.
Cool.
So I think what we believe is if you make it really fair, really easy to understand, make the experience fantastic, you can create value from customers.
Right.
And by offering value-added services, which is our next step, we'll be able to retain them for longer. One of the things we've solved is, how do you keep an active customer? And the revolver is a key piece of that. But that also means there's an opportunity to build follow-on services around that.
Yeah.
And we see strong interest from our 700,000 customer base to potentially provide depository service with a partner. Potentially there's a play for wealth management services. And so in many ways, you land in a place where you could build a bank by reverse.
Yeah.
So I think it's about retaining the client, certainly with some great services around lending, but to extract maximum value, it's about building a follow-on ecosystem of product that can help you grow your business.
Right. And currently you operate in 5 markets. And when it comes to Europe, do you see all those, fragmented Europe basically into 27 markets, one can say.
Yep.
Do you see this as a problem or more like an opportunity?
Yeah,
Challenge.
I go back and forth on this all the time.
I know.
I wish it was one harmonious market.
Yeah.
Because my valuation would be significantly higher, right? Not to bitch a little bit, but if I look at a firm in the US, they've got 10,000 merchants. And, they're $1.5 billion valuation, but it's a harmonious regulatory environment. I've got close to that number, and we're not yet worth €1 billion, right? But the upside is clearly there. I think in lending specifically, it's tough because the market isn't harmonized on how you think about interest rates.
Yeah.
And then on top of that, it's capital intensive. So coming at this with the same lens for each market just breaks completely. So that's challenge number one, and that's more about scaling a solution. Identity in different markets, completely different. Access to credit bureau information, completely different in each market. Access to criminal records, completely different in each market. So that definitely creates challenges.
Yeah.
The flip of that is, if you can navigate those markets well and you can build a meaningful position, actually you can have a huge success, right? Look at what iZettle did. They were about to do an IPO, and they got bought for $2.2 billion by PayPal.
Yeah.
Look at Klarna, $2.5 billion valuation. Look at Adyen. Look at Stripe. They've all done very well, and it's about picking those segments that help you scale. Revolut actually had a very smart strategy, because they're just a payment card company, and that card license is passportable across Europe.
Yeah.
So you start with card, and your distribution challenge is not limited to country. So I think it's a long answer maybe, but it's really how you think about the markets and how you tackle it. We're in lending. It's going to be hard, but we can create competitive edge there.
Yeah.
So I think from a European perspective, any new startups out there, just pick where you're going to start first.
Yeah.
And a big discussion you should have with your team is how the hell do we scale this effectively?
Right. One can also argue that you have 27 opportunities to learn here in Europe, and then you can also, bring it globally. It's much easier because this way or the other you will have to adjust somehow in global markets. But what I would like to talk about now, you have vast experience.
By the way, that's very expensive.
Is it?
Yeah, learning 27 different things. It's expensive, right?
It is.
But you could deploy the same capital,
right?
And you could go and launch a platform business in Mexico.
Yeah.
Look at Nubank, right? Nubank in Latin America, $3.5 billion valuation, harmonious approach, fantastic story, because you just market a solution to a lot of people in the same way. So I think it's a total balance.
Yeah.
Hard to raise money to have 27 tests for sure, but typically, why do we see the big companies coming out of the likes of Germany and the UK? It's because they have access to capital, and they have a huge demand from a maturing or mature customer base.
Right. So isn't that the problem for Mosh?
Yeah, I mean, I think for us, this is why we've moved into markets like Spain and Poland.
Yeah.
Right. So how do we scale there effectively? If you look at, say, Poland, some of the big online retailers we speak to, they're doing 9 million a month of high quality origination. That's just one merchant. You don't really see that in comparable markets. Our other focus is also doubling down on the Nordics.
Yeah.
And making sure we cover all of that market as opposed to being in just two of them. So I think it's a challenge for certain, but we have a strategy with our distribution network partners, so Verifone and Nets, to capitalize on very near-term opportunities and be in the place people make decisions, right? If I just look at Finland, there's 100,000 merchants that we're trying to capitalize on right now through those partners. So I think because we've solved the distribution challenge in the markets that we operate, I don't think the challenge is as difficult for us as it may be for a new entrant or a new player tried to enter the same business.
Right, and in terms of customer base, do you see Spain as a opportunity to enter Latin America, or is it the other way around? Because in Poland, globally, Spanish financial institutions are really strong, right? Surprisingly strong, I would say.
It's a good question. I mean, look, we've been asked to go to LATAM in the past, but right now we're just focused on Europe.
Okay.
I think probably after our next round, once we close the capital, we can start thinking internationally. But I think that's a 2 to 3 year discussion. Let's win in the markets we're at first.
Yeah. Okay. So you have.
This is fun.
This is really. It is fun. I'm really excited about the next question. No, seriously, but you have vast experience in traditional banking. You worked for 15 years in Morgan Stanley, in 5 different markets, 5 different locations, and then you switched to, I would say, fintech words. Why such a switch, and what kind of experience do you bring into this new brave world of finance from the old words?
Yeah, well, it's not my dress sense, that's for sure. Look, I think I had so many different roles at Morgan Stanley. It really was a phenomenal proving ground. My background was in software engineering.
Yeah.
So I started out writing code. That was awesome. I really enjoyed that. And then I think someone at Morgan Stanley, and it's a great company culture for moving people around, noticed I had a personality and decided that it would be a good idea to put me on a plane and go to Saudi Arabia. And I thought I was going to land in the middle of the beach, not in the middle of the country, which is desert, right? So I spent 2 years there, a phenomenal experience in my very early 30s, or just 30, learning how to build an investment bank, working with the regulator, working with the stock exchange, building out different businesses. And I guess that was my first taste of real entrepreneurship.
Yeah.
It was kind of me, a beat up Discovery and some sand and a few other people to start, and we left with a full service investment bank. So really good experience. Then I transitioned to Hungary with Morgan Stanley again, where I focused on building an organization, taking it from 60 to a little over 2,000 people. And that was a good experience of learning how to scale a company and getting the right people in the bus and finding the right leadership roles, and that you can't have success in an organization at the same speed as you can with building something from scratch where you own everything.
Right.
I did my MBA, and then from there I flipped to New York, where I spent a lot of time in strategy. Initially in a job I hated, which was restructuring a big IT department.
Yeah.
2 billion organization, 3 billion-ish. That was hard. And then I spent 3 years really focused on FinTech, both looking internally at what companies we could create and spin out, and then looking externally at what companies we should bring in, and then advising and guiding those companies in partnership with investment banking. So I'd had this kind of concoction of experiences. I mean, I got pretty lucky. It seemed like I had a plan, to be honest, but I just kept doing the things I loved. And I decided, I think, hey, I really want to be on the other side of the table. And even now, when I'm pitching to VC companies or PEs, I have the deepest respect for those guys. They're really smart. But I wouldn't want to be on that side of the table. I much prefer to be the guy running, guiding, operating.
Why is that?
It's just more fun. Life is short.
Yeah.
life is short. I get to come and do these sorts of things. I get to see the hard work that an amazing team is putting in every day. I get to see and then be inspired by their professionalism and what they're doing and what they're getting behind in terms of the MASH story.
Yeah.
And then you get to walk down the street in the countries where you're present and you see the logo of MASH.
Yeah.
And, you remember buying that domain name. You remember picking the logo. You remember picking the value proposition. Again, in the whole team. And that's just so damn inspiring.
Yeah.
Right? You're not just deploying capital or putting in at work and trying to make sure that it goes well. So I think that collection of things, what I found is coming into MASH, clearly we spent a lot of time getting the right team in place.
Yeah.
Right? I've learned that lesson before. Getting the strategy right and understanding where FinTech was really going. And that was really built on that foundation I had at Morgan Stanley.
Yeah.
And then going through the process of getting the business in a place that it could attract a large influx of equity. And that's where we are now.
Right. So having learned what you learned in traditional banking, do you have any advice for the FinTech industry? I know you wrote this great piece about 5 lessons that FinTech industry should learn from traditional banking. Could you give 3 of those, and the rest will be linked in the description so people start reading again?
I think I'm going to probably just give one of them, actually.
Okay.
Because I think it's the most important one. I think the most important thing for FinTechs is to make sure that they have the right partnership strategy. Capgemini reported last month that clearly there's been a slowdown in funding and deal flow in the UK, or rather Europe at large, on banking deals.
Yeah.
So we come off a headline number of 2.7 billion last year of net new funding in Europe for 612 deals, the biggest certain single year in European history. This year we're down significantly and we won't reach those heady heights again. And that's a factor of valuations being a little bit out of control, but also FinTechs realizing that they lack distribution, brand, focus, and distribution. And so what you've clearly seen is the next phase, which is banks shifting to partner with FinTechs, and FinTech shifting to partner not only with banks but incumbent players. So if you look at another stat again from Capgem, 95% of FinTechs are looking at their partnership strategy, and that's really important to get it right. So don't just think of yourself as a service provider. I've heard that a lot even today at the conference. But don't think of yourself as just a FinTech provider or a servicer. Really look to build accretive two-way relationships, and that way you'll be able to weather any economic storm that might come up and have a real seat at the table. So I think partnership and getting the right partner is right. And then certainly on the bank side, there's a whole bunch of other stuff we can talk about, right? Well, banks are about reg, banks have capital, banks have people. That's all goodness. But get that partnership right and work out how you can extract value from them. Right.
Okay. Honestly, from my perspective, I like the part about regulations, but you'll have to read about it. We're not going to tell you now.
It's a really good read.
It is a really good read. Right. So MASH is 10 years old. Bitcoin obviously is also 10 years old.
Yep.
And do you see the history and perhaps future Bitcoin, and by Bitcoin, of course, I mean all cryptocurrencies and blockchain. Do you see that future intertwined or not really?
Actually, it's a good question. I am completely anti cryptocurrencies.
Okay.
And I think...
okay, we have to...
Stop! Look, I think cryptocurrencies are just, it's snake oil, honestly. I think they're clearly holders of value for some, but I don't know I don't know what solution to what problem they are.
That's a great point, actually.
I think blockchain is very exciting.
Yeah.
And I actually think we're going to shift away from this notion of cryptocurrencies to the notion of really the internet of value. So being able to tokenize or to digitize your entire asset suite and be able to use those in a meaningful way. So for example, it would not surprise me in a year or two, let's say 3 years, if you as a person could look at your assets, and let's say you have a house, and for the interest of math, let's call it $1 million, and you say, look, I'll securitize or tokenize my house, and I'll slice it up into 110,000 coupons or tokens. And what I'll do is I can then use those. I can either unlock one or two by being able to get liquidity for my property for a purchase, and I can do that without an intermediary, or I can exchange that for another token where I feel there's a better upside for that business or that investment than what I have today. But you'll have an absolutely digital set of assets. So I think that's very exciting, and I think that's the real value of blockchain in the future. Now, this isn't craziness. We've just seen JP Morgan tokenize gold. We're actually tokenizing or digitizing our asset base. So I think there'll be a strong. There could be, and I'd hope to think there is, a strong shift towards tokenizing your entire asset pool in the future. I had a great conversation with a Singaporean regulator on this, or rather the stock exchange, not the regulator. And their view was, listen, they think every single asset will be securitized in the future, or tokenized in the future. And I think that's right. Next 5 years, it will be completely different.
Right. There's even talk about tokenizing your personal data, to turn the tables on all those big companies, Facebook, Google, who monetizes your data and you do not really profit from it. So then you can have some control over it.
That's a great one. And think about the control, right? Think about what you can do on chain. You can then control your data automatically with your own contract. You can define how much you would want your data to be sold for, where to deposit it, whether it's tradable, whether you'd exchange it for another kind of token that's not cash. So I think there's a lot that can happen there. I think we've got to find that first use case.
And I think the whole blockchain technology, it follows the path of all those maturing technologies like the radio, the internet, more or less, right? So you can see that institutions are maybe not really putting their hands on it, but implementing it in an interesting way and making it more logical and more useful, I think.
I think 90% of institutions, in either banking institutions in Europe or the US, have some kind of blockchain activity happening. JP Morgan, Goldman Sachs have their own implementation of a chain. So they're doing something. I think it's hard to move an institution. Ripple obviously have done great work in this space, although they're with their Ripple token. So I think we're just going to have to see what happens. But whoever nails it, particularly on the individual side, on the consumer side, I think that's a multi-billion, potentially trillion-dollar company.
Right. So this is where we should look for the killer app, not with Bitcoin or.
It's a killer application. You're right. It's the killer application. Right. People are going to continue to use Telegram to pump the valuation of cryptocurrencies, and in that environment, it's not the holder of coin that makes money, it's whoever's pumping the channel. So I wouldn't touch crypto with a 10-foot pole. But I think in terms of who can come up with the best application of using the fundamental blockchain technology is the one that can win, especially if it's a compelling consumer technology. And the key here is you haven't got to lead with blockchain. It just so happens it can be a great value proposition that just uses blockchain technology. Because clearly the winners of the next phase of fintech will be those that can do it simply.
Right.
But I think that's the space. If I was starting out, that's where I'd spend a lot of my time.
Right. Maybe this is an idea for your next project.
I don't know if I'd have time. I'm hoping.
I know you in no liberty to comment on that. All right. Okay. Thank you, James, for this.
Thank you.
Conversation. Ze mną był James Hickson z marnie.com. Rozmawialiśmy o wielu ciekawych rzeczach. Więcej możecie dowiedzieć się z opisu pod tym linkiem. A jeżeli podobała Wam się ta rozmowa, możecie zobaczyć więcej w naszych kanałach social mediowych. Dziękuję bardzo i do zobaczenia w internecie.